We should be live on YouTube. Yes, we're live. Okay, so this is Tradingview. This is the most popular and common charting website or software that people use. Just tradingview.com. I downloaded the app just because I like it on my computer instead of going browser based. They work pretty much the same, just feels a little cleaner to me using the app. You don't have to. It's free to use. You just sign up. You don't have to pay anything. Uh, However, right now they do have an 80% sale for Black Friday, and it's only going on like another 4 days. 80% is really good. Uh, because like at the basic level that's completely free, you only get two indicators. So you'd only be able to put on like an EMA and an RSI or something. Just two indicators and that's it. I think when you go to the first level, it's like $15 a month. And 80% off of that, it comes out to like like $50 or less for the year. It's it's really just like $30 for a year if you buy it right now during the 80%. And I think that gets you like either maybe five indicators, which is it's pretty useful to be able to have that many more indicators. And I'll explain why later, but let's go ahead and just start off with over here on the left, you have all your tools. There's things to point at, trend lines, click, draw a trend line. Then there's a little arrow on each of these. You can choose a different one. There's different types. There's ray, info lines, extended, all this stuff that you can look through. When you draw a trend line like that or any object on the chart, you click on it and then you hit, there's all sorts of colors. That's the color of the text, line thickness, style, settings. Visibility is the time frame that it's visible on. We'll get there in a minute. Style, you can extend it, extend line to the right. See how I clicked extend line to the right? You can play around with that, okay? These are your tools. A measuring tool, zooming, magnet snaps your crosshair to the candle. Hide drawings and delete. Okay. And then we go up top. Here in the top left, you have a symbol search. Right now it's BTC USD. You click on that and it pulls up a symbol search. Here's the ticker name. That's what we call them. They're called tickers. So BTC USDT, that's Bitcoin priced in Tether. You can also do Bitcoin priced in something like gold, which is BTC XAU is the ticker. So see Bitcoin priced in gold, and that's a different chart. See, it's different than the one that we were just on. So that's how you do that, selecting between them. I have a watch list here. That's this top right button, quicker and easier for me to get to. I'll show you how to build that in a second. Let's go and delete that. Going on from left to right, there's your, what do you call it, profile settings with your name, things like that. Carrying on, compare add symbol. Here's a really important section. All of these times, 1 second, 5 second, 10 second, 30 second, 1 minute, things like that, that changes the duration of each of these candles. Okay. This is kind of getting into basic technical analysis at this point. Right now, we're on a 5-minute chart. That means every single candle, this candle, this candle, this candle, they're all 5 minutes. Okay. And what they represent is open, high, low, and close. So you see where there's this wick right down here, and then this wick above, That's the high and the low for this 5-minute candle. If it's a red candle, that means it opened higher than it closed at the end of that 5 minutes. You can see down here at the bottom of the screen, 16:10. So at 4:10, 10 minutes ago, it opened at 4:10 right here at 86,376, ran up, ran down, came back up, and closed here 5 minutes later. Um, so yeah, there's your high, low, open, close. That's how you read candles. And there's a lot of information in each candle that leads into uh, candle types and patterns. So, like, here's a pattern that you'll see. There's a small green candle with a big red candle following. We call that a bearish engulfing. We have names for all of these patterns and types of candles that you see, like these tiny ones right here, where they're pretty much the body is the fat part, and then the wicks are the longer part. When the body is really small and the wicks are longer, we call these dojis. Things like that. Okay, you can study candlestick patterns for a long time, and I really recommend understanding candles and candlestick patterns because that needs to be the uh the foundation of your trading or investing. They Because that tells you, I mean, that's really what you're after, right? You're not after uh you're not after, oh, is the RSI oversold or overbought. You're after the price itself. That's really what you're after. That's the meat of it. And that leads me into uh something like an indicator trap is what I would call it. I think too many people first come into investing or trading and they learn about indicators and they're like, "Oh, I'm gonna find the perfect indicator that's gonna it's gonna lay it on the chart and it's going to tell me buy or sell and it's going to be right 100% of the time." It doesn't work that way, you know. You can't do that in investing or in trading. It's a probability game. You can't be focused on the outcome. You need to think about probabilities and that you will lose. There's a really great trader named Tom Hugard who says the best loser wins. So if you're able to take the losses in stride, not try and win it all back, but understand that losses are part of the game, both in investing and in trading, then you're going to have a lot better time in the long run because it's about managing your emotions, realizing that nothing's perfect, and you roll with the punches. So I would say price action is king. And when I say price action, it's what a lot of people are talking about is two things. They're talking about what the candles are doing in a kind of bigger picture of things. So, like, you can see starting from right here in this section, right here, there was a little bottom, right? And the price action changed from coming down like this and it started working its way up. There's the path. It came down, up, down, and everything goes in waves, but it started working its way up, right? And then here at 3 o'clock, my time, it took a sharp downturn. Now, we're gonna talk about the strategies in this later, but you can use the tools in TradingView to go a long way with just price action. So it's not like you need to load up all these indicators and pay a bunch of money. Uh, People are going to try to sell you their indicators for a lot too. like 400, 500, or $1,000. It's like, dude, just invest that $1,000 and then take another 1,000 and try and trade it away. You'll learn a lot more that way. I promise. Okay, let's see. Finishing up the TradingView uh, explanation of the tools. So here's time frames, right? We're 5 minute. If we go up to 4 hour, this one candle right here is the last 4 hours. So if you see at the bottom, it says 16 o'clock. The other one started at 12 o'clock. This one was at 8 o'clock. And right here on that 5 minute chart is where I was talking about. See, the red candle goes down. There's that second push lower, right? Remember on this 5 minute chart, right? Back here, it came down, up. Oh, it's even, wait, 12 o'clock. Yeah, 12 o'clock, 4 hours before. Starting Friday at 16 o'clock. It went down, down, and then it started working its way up. You can see all of this information from here to here on the 5 minute chart, scrunched up together on the 4 hour chart from here. See, Friday, 16 o'clock, down, down, and then it started working its way up. You've got that up, down, the wicks, and it came back down, up, and then it popped above, went down, it closed below, came up, and up, and then now we're coming down. This is why I'm saying it's important to study candles and read it so that when you look at a chart like this, it's not just like, oh, square, 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 but you're actually able to see it opened down here and it came up and it went above and then came back down before going back up. And here it probably went up first and came back down, had a little bounce, things like that. You need to be able to read the candles. And you need to know what time frame you're on. So this is a 4 hour chart. They're each 4 hour candles. You can't just look at any chart like this without any context of what's the time frame of each candle, because a 1 day chart is going to look different than a 5 second chart like this. Look, the 5 second just moves. It's going every which way. Looks like it's jumping up and you're like, oh, it's bullish here. Look, Bitcoin's bottomed, and you're on a 5 second chart or something, or a 1 minute chart, and you get blown out because the shorter time frame of your candles, the shorter your trades will be. So that's the importance of understanding your time frames. So if you're focused on investing, I would really recommend probably no lower than a daily time frame. I think a daily time frame is really good for investing. You're going to have a long time horizon, you know. You're going to be talking years. The bottom on Bitcoin came in back in 2023. It went up and a higher low and then a higher high from there. And oh, look, now you're in April of 2023. You're like, oh, okay, you know, I could probably buy it in this range somewhere. It's moving up. So let's just go ahead and buy these little dips. Like, oh, it came right here to the bottom at 26.8K. And you'd get some drawdown, it'd come up, it'd look like resistance, and everybody trying to trade the 1 hour or 4 hour chart in this area is like, oh, Bitcoin topped out right here, you better sell, it's over. And it dumped, and they're like, see, we're right. And then what happened? It formed a bottom and it took off. So if you're selling down here at 30K because you're looking at the 4 hour or the 1 hour chart trying to catch every move like a trader, that's not investing. So you need to understand your time preference. So we're back in April of 2023 when you would have bought. And then now we finally went off of a cliff pretty hard. So it's kind of like, you know, you could probably look to be taking you should be taking profits after a new all-time high, you know, peaked out, you're going to take it at the highs. It's going to go, oh, cool, it runs a little more. Even if you sell here at 95, 96K, you're just taking a little bit off the table. You're leaving a big bag in, you're letting it ride up and down, very long time preference. When it goes down, you put a little bit more in. When it goes up, you take a little bit off. That's investing. You're not trying to catch every move. And I do that alongside trading. So I think it's important to understand the difference in time preference there. I'm going to move on to talk more about trading because when you understand trading and you're focused on your risk management, it makes it better for your investing aspect. What do I mean by shorter trades? I mean the targets that you're going for, uh, as well as the amount of time that you're in it. So let's say that I'm here on like a 1 hour chart, okay? And let's say I short right here. This is Monday, November 10th at 4 o'clock. And let's just say I just want to ride, I just think that it's topped out here and I just want to ride it just to a new low. So let's say I'll just take a profit right here. I don't care if it goes lower, but on a 1 hour chart, this is, let's count the candles really quick. Right here to, here's your new low. 74 bars, 3 days. That's a 3-day trade. 1, 2, 3. I look for the new lows. Boom, there's my new lows. I don't care if it goes up or down. I've taken my profit. I'm good to go. 3 days, in, out, 8% move. That's a winner, okay? Now, if I look for, how many bars was it again? 74, did I say? Yeah, 70, 76, 74. Let's look for 75 bars on a 1 minute chart. Well, you can pretty much tell already that's going to be like 2 hours, right? Look, here's another similar looking move. Let's say I short right here, and there's 75 bars. 75 bars on a 1 minute chart only lasts an hour and 15 minutes. So it has the same chart structure in terms of what you're looking at, right? Like this kind of pattern looks similar to what we just saw on the 1 hour chart. And uh, the candlestick patterns, you'll notice with enough time and experience, they're fractal. So what you see on the 1 minute chart will be mimicked to a degree on a 5 minute, 1 hour, 4 hour day. Excuse me, daily, weekly, monthly. You'll see the same layout of the candles looking similar. Like, just take that big dump. Oh, look, there's 75 candles to a target. Good to go. But it was also from here to here in those 75 bars, instead of being 8%, it was only 2%, 1.8, 2%. See, so it's significantly shorter of a time frame, or sorry, of a percentage gain. So the smaller the time frame, the smaller percentage change you'll be going for. That's the difference between investing and trading as well. Trading, we're generally looking for more of a quick in, quick out, get our trade. And you can do longer trades. I don't mean like just day trading. There's swing trading. So if you guys want to do swing trading, generally people look at like a 1 hour, which, like I showed, about a 3-day trade is kind of the 1 hour time frame you'll be looking for. And on a 4 hour, let's say you sell this big candle right here. That's not really fair because that was kind of an anomaly. Let's go to a random spot and just choose. Okay, this is good. We're looking here. You always look to the left. You can see that there was a resistance right here, right? Right there, it was rejected. So you take that level, comes up to that level. Cool. We have a bearish candle with the tweezer top candle. Boom. Rejection. This is great. We would take our uh, measuring tool. There it is. Let's just go 75 bars sideways. There you go. Look, 75 bars sideways. From this first candle, 75 bars, it ends up being 12 days and 20 hours, which is standard from my experience, is about 2 weeks. Okay, so there's different types of trading. So daily is going to be investing or very long trades. Daily and higher candles is going to be investing or very long-term trades that will be months long. 4 hours is going to get you into about the two-week time frame. Sometimes it can even extend beyond the 2-week time frame if you catch a really good swing. 1 hour will be about 3 to 5 days if you're using the 1 hour chart. And then everything below 1 hour is going to be day trading. You're not you're generally not going to hold a position that you have your setup for. Like, say here, it came up here. Oh, you see it rolling over, lower high. All right, we're going to go right here and we're going to short. And let's go 75 bars. 75. Look at that. It even hits the bottom. See, that's 18 hours. It's less than a day that you would be in this trade for this kind of a move. When you get the setup, doesn't always work that way, right? You know, you could, which don't, this is a Friday. This is why it went flat here. If you're going to do day trading, don't day trade over the weekend. If you're going to do the 1 hour chart, look for your position on Monday or Tuesday and then close it out by Friday. It should, which that's a type of swing trading. When we say swing trading, that means you're going to be holding a position longer than 1 day. When we say day trading, your position is held for less than a day. There's also a term called scalping. Scalping, I've seen used in longer term time frames like the 1 hour or the 4 hour. But what scalping looks for would just be like, oh, we're moving up here. I'm just going to take just this little move from like right here, boom, like 2 candles, just a couple of percent in, out. I don't care if it goes further. Their scalping is aiming for like a 90% win rate, but you're just looking for just the tiniest little moves at a time. Okay. So these are the different types of trading that you can get into. I would recommend for people first getting into it. Excuse me. I'm finishing up a cold, so my throat is a little wonky. What I would recommend for you guys first getting into it, okay, is focus on the daily and weekly time frames. Okay? You're going to study the charts in terms of where we're at in any kind of a cycle. You're going to look for patterns that played out. Like, and I'm going to get into that later on with like trading setups and how it can be utilized. But everything should be top down. It should always be bigger picture. Like, even when I'm doing day trading, like, you know, holding a position for 5 or 10 minutes, even, I actually have a solid understanding of where we are in the daily chart and higher and everything in between. So that's why I would suggest starting with the higher time frames first to invest. Get your feet wet. Um, uh, dollar cost averaging is an important thing, and we are going to talk about risk management later for trading, but in terms of investing, the easiest way to manage your risk is to dollar cost average, which just means when it goes down, you buy a little bit, but and or you even if it goes up, you buy a little bit more. But what you're investing is only, you know, 5% or less of your paycheck at a time. It's, oh, instead of going out to eat this week, I'm I'm gonna take that $15 or $20 and I'm just gonna put it in Bitcoin and I'm gonna act like I ate it away and it doesn't exist. Or I'm gonna put it in the S&P 500 or the NASDAQ or whatever. There's all sorts of things that you can invest in. When you invest, you put the money in and you act as if it's already gone. It doesn't exist. And you have a 5, 10, even 20-year time preference to where you leave that money alone until you start taking profits off of it. A trading account is different. You're going to be actively taking trades on it when the opportunity arises. And again, like I said, you can do that on a daily time frame. It's just going to take longer to play out. Okay. Let's get into all right, so price action is king, volume is queen. That's a common thing that people will talk about. I would say maybe. Volume are these bars here at the bottom of the screen. And it's there's an interesting thing that happens when volume picks up. It's either the start or the end of a trend. So, like here, you see a big spike in volume, right? This candle has a lot more volume, and look at where it is. That was the top of Bitcoin back in January. Same thing right here too, but this is a doji candle. So you want to incorporate price and volume analysis. Volume is always important to look at. If you see a big candle like this, like people will get excited. They'll be like, "Oh, boom, big candle." But let's pretend that there's no volume here, right? Let's say, "Oh, cool, we've got an uptrend, uptrend, uptrend," and then boom, big spike candle right there, but there's no volume to accompany it. Well, that's kind of a fake out sign. That means there was some kind of price manipulation on lower volume or some kind of retail hype that didn't play out. So even though the price action looks like it's going to go somewhere, it could absolutely have no volume and just plunk out, fall right over. You just bought what you thought was a breakout and we're ready to go higher, but nope, you just go and you get stopped out. Oh well, it happens, but that's why we have a confluence of volume price analysis. There's a high here and it went down. You come down here, you start seeing at these lows right here, this low candle and this candle, there was an increase in volume compared to this section beforehand. Cool. It bounced. There was not as much volume to accompany this buy, went back down, came lower, bounced one more time, pushed the lows, and you have more volume coming in. with, boom, a big bullish engulfing candle. Bullish engulfing just means that the candle here engulfs the candle right before it. It's significantly bigger, so it engulfs it. That's what we mean by it. And it's there's volume here included at these lows. So both times that price went down to the 75,000 level, it got bought right back up. And it was a low volume sell off. See, this red candle in the middle is low volume. There's not a lot of sellers in there. And as soon as it gets lower back to 75K again, what happens? High volume again. People want to buy it up. So that's an important meat of when you're looking at a chart and what you want to think about. And this is still in the realm of analysis, and it's still in the realm of being an investor, because even though this is kind of a trading technique, you guys can identify this stuff and be like, oh, cool, there's a lot of buying interest coming in here. Let's just go ahead and pick up more. Now, let's see where we are now in Bitcoin. What do you guys think? There was a big sell-off, lots of volume, rolled over, volume shrank. At the lows here, there was a lot of volume, not as much as back here. And then as we trailed down, we had an increase in volume into this smaller candle with a lot of volume, and it wicked back up. That's, if I'm just looking at price action, I would go, and for a long time preference, I would go, this is a good spot, just like back here in January or something. It's not a guarantee that it's the bottom. It could go like this, go down, back up, could come way up, and then come back to a new low. Because here the bottom was 79,000, and we went sideways for a while and came back to 75,000. So, I mean, that's completely possible where we're at right now in Bitcoin. Bounce up a little bit, come lower, push, 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 and then maybe turn up higher. I don't know. But these are just the things that we take note of when we're trying to find an edge. This is a statistical edge of when price has this kind of movement and then a push back up accompanied by volume. Well, you kind of have a statistical edge, and that's all you're looking for. And like I said, nothing's going to be perfect. Could come back lower, could run straight up, push all the way through, kick out all the shorts. I don't know. But we just kind of take it a step at a time, be patient. When the setup presents itself, run with it. So here's the other thing to analyze in price action. I like to keep it simple. There's 3 types of price action. There's ranging, like this. Okay. See, that's a range. Here's the lows, here's the highs. It's bouncing back and forth, just like that. There's a fake out. So if it's in a range like this, and it comes down, it comes up, let's say it goes a little higher, but then it comes right back into the range and it keeps going through there. That would be the fake out, because everyone thinks, oh, here's the previous resistance. Price went above. Oh, it's a breakout. We're going to start trending up. So they'll buy, but it falls apart and it comes back in. And then there's an actual breakout to where it goes like this, goes up, and it goes to the downside, gets rejected off of the floor right here, and it goes to the downside. You'll see these 3 things are the only thing that the market can do. That's all it can do. It can't go any other way. Those are literally the only 3 things. So that helps make it simple, right? Take this section back in the beginning of the year. Where's my box? Little box, range box. There it is. Here's the, let's go right there. I like to go with kind of what meets the most. So if we zoom in, you can see price came down here, got a support, went up, wicked down, came back up. You know, when you're choosing these supports and resistances for a range like this, like if you're in the middle of it, closes are important, but you also want to capture as many points of interest as possible. See, a wick means that it was a point of interest to where it got so low that buyers stepped in. And then at the top, it was a point of interest that sellers stepped in, right? And it went the other way. And it's really close here on this wick. And then there's kind of a middle range. You know, I don't like to play the middles. The getting an extreme is a little better. And it's just bouncing back and forth, just like this, right? And then you have a breakout from there. It tries to return up in and rejected. So now, after you have this breakout, attempt to push back into this range that we have marked, well, that's an actual breakout, right? That's not a fake out anymore. So you would either sell as you see it coming out of this range, or the second lower high, like in this 89K region right over here. And it comes down and it comes down and does that. Okay. But then look what happens. You come here and it comes up and down and up. Well, look, now we have another range, right? From this low to the close up to these highs where it's bouncing between. It comes up, it went above that range. You can't see that though until you start to get either into here or into here. At least in terms of a clean box like this. So instead of a box, what I like to do that you can do as you go along, especially like here's the way that I would mark where we're at. We had this up, down, up, down, up, down, down. Well, you can see that this was the previous floor that was holding for a while. So every time it got here, there was a point of interest. So on Tradingview, you come over here to the right, there's this little plus button, and you just tap that plus button. Well, and look, it's at 100K. So when you tap that plus button, it says draw horizontal line at 100,072. You can also add an alert, and notifications will come up in the bottom right corner here, the little bell. I like to have horizontal lines to see it. Sometimes I'll add an alert as well. But there's our horizontal line. And see, there was that point of interest. And if we go back, oh, look, wanted to stay away from 100K, but as soon as it got to 100K, which that's an easy one because it's a psychological resistance or support. Psychological numbers mean a lot to the market. It may seem arbitrary, but something like $100,000 is really psychological to the market. And also pretty much every multiple of 20, so 80K, 60K, 40K, 20K, those are of interest. 25, 50, 75, they can be. They can be, just like we saw 75K here, 100K, and then 125K. So multiples of 25 can be. I would just go by what the chart is telling you to the left. You always go to the left. So like if we want to see where our next point of support would be for Bitcoin, see, well, there's this range. So we'll do the line right there where we get the breakthrough, resistance, resistance, came down and broke through, and it broke through with aggression. And then here's our support. Oops, I want that down at 75K because that was kind of the low. Maybe a little higher. I like where these closes are. Opens and closes matter too. That's the other thing that I wanted to talk about before I get too much into the trading aspect. It may seem kind of arbitrary that a candle opens and closes at a certain thing. It's just like, oh, it's just the price is moving up and down. Actually, the open and close matters a lot. Like here you have a close at 78.5. Here you have a close very close to it, especially because it wicked below and came up, and it wicked below and came above. So the fact that it wants to finish out this candle kind of in this range, that's a little bit of a hint before you even get here. So pay attention to the wicks and the opens and the closes, okay? And try and study and see what the market is telling you about each of those 4 price ranges within every given candle. Um right. So price action, ranging, trending, or a fake out, where here's an example of a fake out where you think, oh man, you know, this is our 100K floor right here. Look, it doesn't want to go below 100K. We're pushing higher. We come back, we get support. It doesn't want to go lower. It doesn't want to go lower than 100K. We're ready to go. Oh no, it broke below 100K down to 98K. And then what happened? Instantly bought back up. And then the next candle dropped below again, fake out, pushed higher, and we're off to the races. This is a classic example of a fake out because it faked out going below that 100,000 level and it reversed on you. Okay. So those are the only 3 things that you need to look for. And then the question is, how do we decide which is which, right? And that's where strategies come into play. But I'm just trying to keep it simple because these are just the simple ways of looking at the market and asking yourself, are we trending? Or are we ranging? And if we're ranging, is it going to break out or fake out? That's basically it. You don't have to overcomplicate it much beyond that. Even as an investor, yeah. Okay, the next aspect of the basics here would be market psychology. And a thing that we want to try and do when we look at a chart, even without going on X or seeing what people are talking about in terms of, oh, what's Bitcoin doing or whatever, there's 3 aspects of market psychology that I think are the only ones that matter. Everything else is just kind of noise. And the first one is apathy. Apathy is boring, sideways. You're spending from this low all the way over here that looks like a big range, 265 days in mostly a 30% range. aside from this breakout down below and back above. That's a long time to do nothing, right? That's boring. Apathy is one of your best friends in long-term investing, okay? If you're going to do long-term investing, the apathy period is where you want to be going as heavy as possible when it's boring. Also, if we go back here to 2018, my goodness, this was boring. This big capitulation. Even this period was boring. And then out of nowhere, boom, 50% drop. Look at that. 50% drop. And then from the bottom there, whoops. From the bottom, it was another 100 days. That's a third of a year. It's boring. That's when you want to be loading up the bags when nobody's talking about it. You need to set reminders to yourself every year. Be like, oh, look at the chart. Has it been boring for, 2, 3, 4, 6, 8 months? That's when you need to load up your bags. And then it starts getting exciting. Ooh, Bitcoin's pushing up 47K. Whoa, we just took a straight run all the way up to all-time highs. We broke through the previous all-time high to this all-time high. So if you had bought down here in this range, you're going from 23 up to 73. You 3 times your bag. You can take a little bit off the table. It's completely fine. You don't have to get rid of your whole bag, whatever it is. Say you've got 10,000 into it down here, and then you're up 3 times. Well, now you're up to 30,000. So you're down 10,000, you got 30,000, take 2 or 3,000 off just for when there's maybe dips. And if you were to take even 2,000 off of a 30% bag, let's say you're able to catch these bottoms that are 20% lower. Oh, 20% dip, cool. I'm going to put that 2,000 back in. Well, what's that $2,000? 20% increase, 10% would be 200, so twice as much, 400. You just went from 30,000, but it went down 30, I don't know, 20% of 30, math, 15, 600, $600 something. No, more than that. Sorry. 6K? So you're 24K, but now you're at 24.4. So even though it was a 20% drop and you only took less than 10% off your bag, that 20% drop just increased your bag from 400, just increased your bag by 10%. So a 2% profit taking up here increases your bag by 10% on a 20% move. That's a small amount of profit taking for a much bigger bag. And even if you go lower after this, let's say this was it and you go lower, well, you believe in it long term, right? You're not going to touch it for 10, 20 years, but if you take off 1 to 2% at a time, or even less than 2% every year or two, and then you buy back in 5, 6 months later if it goes down, or what if it doesn't? What if it goes higher? Cool. You take a little bit more, but nothing just goes straight up forever, I mean, we look at something like the S&P 500. You have opportunities to where it's going up. Oh, I'll take some profit in here. It keeps going up. Okay, it's down to the same area. It keeps going up. Down to the same area. It keeps going up. I like it. I like it in this region. Okay, I'm going to take 2, 3% off. And you get a nice drop. Okay. Even you get reverted back to 2024 levels. And you were selling in 2025. So you locked in some of the gains from 2024 up to 2025. You had an opportunity to take these profits from here, put it right back in. This is an investing strategy. It's long-term. It's very simple. You're managing your risk. You're taking bits of your paycheck, always putting it in, and then you take a little bit off at highs when there's euphoria. And then when there's fear and things like this, you're going to slowly start putting it back in, because even from here to here, you don't have to know anything about trading. All you know is, wow, it dropped really hard. I'm just going to go ahead and put a little bit back in now. There's my dry powder. Oh, it went lower. Cool. I'm going to put a little more in. Oh, it's going up again. Cool. I'm still in these lows compared to where I sold off up here. Okay, and I make it back up to here and we're trending. All right, I'll put the rest of my dry powder back in, but I have a much bigger bag. That's your goal of investing, is to increase your bag size that you have. And you're looking for the market psychology mostly on that. When I'm looking at a chart, I'm looking for market psychology. And it even works on shorter time frames. People in Bitcoin are very fearful right now. That causes some kind of volatility and funky action, but you know, it is what it is. We just roll with it. So there's the fear. Fear and greed is up high. When you start feeling euphoric, you got to learn how to recognize it. When you start getting that sense, let's say you bought here and it goes way up and you're like, wow, I'm really up. Let it be a signal to yourself that, oh man, I should have bought more. Counter trade that. Be like, okay, if I feel like I should have bought more, I'm actually going to take a little bit off the table. And again, it just has to be 1 or 2%, just a small amount. And wait, be patient. We're dealing in the daily time frame, so you're not going to do really more than one action a week at the most. Should be drawn out over the course of like months, you know? So if we go back to Bitcoin, here's what we're looking at. Next step. It doesn't matter too much for investing, but I will mention it here. Is there's 3 market sessions that you can uh, participate in. There's the New York session at 9:30 a.m. Eastern Standard Time. There's the pre-market before that for like 1 or 3 hours, and I'll show you here. I'll show you how it looks, because you can see as soon as it starts on the chart. Actually, here, we'll even go to the 1 minute. I'll show you how it looks. It's really interesting. Sunday, Monday. Let's get into Monday. Looking at the time frames here. Where are we at? Oh, no. Sorry, we're still too fresh here. We got to go back. Let's go back here. Saturday, Sunday, Monday. Okay, here's the last week. Or a week before or something. Oh, did it move? It moved me again. Booger. Yeah. So here we're looking at Thursday midnight. This would be the start of the London session. London session. This was a boring day for London. But then look, right here, you have the pre-market hours, big spike in volatility right at 5:30 on the dot. And then it's different in crypto, I guess. You have like 5:30, 6:30. I tend to look at it more like 6:30, but maybe oh, 1 second. Okay. I just wanted to do this quickly. You can see New York volatility. It's a very volatile time in the New York session, and that ends at uh, 1 o'clock. Though if they have a lot of volatility, you'll see a switch at 9:30 or 10 or 11, somewhere in here, and it calms down. And then Asian session tends to trend. That doesn't matter too much for people not that are not day trading, but if you are doing investing and you're kind of looking at it, trying to figure out, oh, what's the best time of day for me to uh, choose when to either enter or exit a position, it'll probably be, it doesn't matter too much because I mean, there's only so much that it can go. I would probably choose the daily open, which would be after the Asian session or at the beginning of the Asian session after New York is done. So that would be about 7 or 8 o'clock Eastern Standard Time. That's when the daily candle closes. And remember, I was saying candle closes matter. So I would wait for the candle to close because that's what you're looking at here on the daily chart. Even if a move like this, maybe you want to buy here. It's fine. It doesn't really matter too much because, when you're talking about a big move like this, the difference between here and here doesn't matter too much. But just trying to be precise, closes matter. Take something like this, which I know that this one happened very quickly. It was like 10 minutes down and back up. But if it was longer, say it came back up, but you sold out down here instead, if you had waited for the close, you could have had a 8% difference, you know? So wait for the closes. That's my advice. Take and exit your position on the daily close for long-term investing, which would be in the afternoon for us Americans. Um I think that's about it for the basic investing thing. I'm going